Hi, Nero here from Investment Rise, and if you've been watching any of my videos, you know I've been saying it for a while. The Sydney property market is cooling, and now we're seeing even more evidence of that than ever before. Check out this chart from the Sydney Morning Herald, which shows that auction clearance rates in every single market in Sydney is far less than it was just 12 months ago. And auction clearance rates in Sydney are a clear barometer about demand for property and obviously price growth. So what's the one thing that could reinvigorate our Sydney market? It's the RBA dropping interest rates. In fact, I predicted that the property boom in Sydney would actually end at the beginning of 2016. But then what happened? The RBA decided to go and give us 2 rate drops in 2016, which gave some more steam to the market. But right now, the RBA has indicated their next movement is up. And in fact, the banks are even raising interest rates. Yes, primarily for investors, but also for owner-occupiers. Also, banking restrictions are being tightened. So there are a number of factors in play to try and cool the Sydney market down. So if you're an investor, you need to start looking at whether now is the time to enter the Sydney market to get capital growth over the coming few years, or should you be looking at other markets? But here's what's interesting. There are still some media reports that Sydney prices are rising. So how do you cut through all the fluff? How do you actually get some clarity here? Because there's so much confusion. Well, let me try and clarify this for you very simply. And it's a little scary actually. The demand for property prices, the price range where there is still lots of demand, is actually prices above $3 million. Those properties are still in hot demand and going very quickly. But in the medium price points and lower price points of under $1 million, even from $1 to $3 million, demand is slowing. Why? Because in those mid to lower price points, people still need mortgages. And when rates start to rise, they can't afford as much anymore. But in those price points above $3 million, these people are not relying on mortgages, or their mortgages are small, or their incomes are extremely high. So they're not concerned about rate rises. For example, Longueville in the lower North Shore of Sydney has a median price point of $4.5 million. And that's the lower North Shore. Yet over 55% of homes in that suburb have zero mortgage. So rates rising, banking restrictions make no difference in that suburb. Prices will still rise as there is demand at that upper price point. But if you're not playing in that upper price point, as 99% of us are not, then you need to start being smarter. You need to understand that if you are looking to invest in that $1 million price point or less, the Sydney market is starting to run out of steam. Many people are talking about prices dropping. Look, in 2004, the apartment market did drop by 20%. But whether they'll do it again, I don't know. But you're not going to get a lot of growth going forwards. So I definitely start looking elsewhere. Look for markets you can afford. Stick to houses. Stick to capital cities. And then you'll be fine. Because remember, there are always markets that are growing. Just because Sydney's slowing down doesn't mean that other markets aren't starting to grow. Keep looking, and I wish you profitable investing.